Not to start with, financing is an important factor in the growth of a business and much more essential for startup companies. When you set up a startup, the very first aspect that clicks your mind is, how am I going to work this business out? And how can I fund my business? Right? Yes, no matter what you do, everything in place demands finance. Financing is an important issue for startups to drive their business growth. But what's important is to select the appropriate financing method. Now, the appropriate financing method may vary, as it depends on the situation of the company and the purpose of financing. There are many ways to raise money, and the appropriate way to raise money depends on the company's growth phase and purpose. Hence, for this video, we'll specifically introduce the contents and features of various financing methods. But before anything else, let's get a basic understanding of a startup company and a venture company, as many of us get confused between the both. What is a startup company? What is the difference between a venture company? What is the difference between startup companies and venture companies that you often hear in business in recent years? Although there is no clear definition, both are used with almost the same meaning, and among the newly established companies called venture companies, especially the group of companies aiming for rapid business growth by utilizing the latest technology is startup. It seems that they're often called companies. In recent years, companies that used to be called venture companies are now called startup companies, and there are increasing cases where both are used in the same meaning. Now, coming to the important area of today's video. To be precise, diversified financing sources not only allow your startups to better weather the potential downturn, but also increase your chances of obtaining appropriate financing to meet your specific needs. Note that. Learn from bankers. They don't really see themselves as your only source of funds, and what they show you is that you have inquired or used various financing alternatives and explained to the lender that you're a proactive entrepreneur. Welcome back to our channel. The topic that we'll be discussing today is how to get funding for a startup business, 7 excellent sources for startups. But before we start, subscribe to our channel and don't miss any updates. Whether you choose bank loans, angel investors, government grants, or business incubators, each of these financing sources has specific advantages and disadvantages and the criteria they'll use to evaluate your business. Hence, the following is an overview of 7 typical sources of financing for startups. 1. Personal investment. When starting a business, your first investor should be yourself, either with your own cash or as collateral with your assets. This might not make sense to you now, but it's a true factor. It's better to hold some amount of money from your own pocket, at least to get started. And it's an important aspect to consider, as this proves to investors and bankers that you have a long-term commitment to your project and that you're ready to take risks. 2. Secure money. As with what we have discussed in the first point, this one got some revelation with it. To be precise, this is money borrowed by a spouse, parents, family, or friends. Investors and bankers see it as patient capital. That is, funds that will be repaid in the future as your business profits increase. When borrowing love money, you should pay attention to many other objectives. As family and friends rarely have much capital, what they may want to own is equity in your business. Hence, business relationships with family or friends should not be taken lightly and should be understood cleverly. 3. Venture capital. Discussing venture capital, the first thing to remember is that venture capital may not be suitable for all entrepreneurs. From the very beginning, you should realize that venture capitalists are looking for technology-driven companies and companies with high growth potential in areas such as information technology, communications, and biotechnology. Venture capitalists hold equity in the company to help it develop a promising but riskier project. This involves transferring some ownership or equity of your business to an external party. In addition, venture capitalists also expect healthy returns on their investments, which are hugely generated when companies begin to sell stocks to the public. As a result, be assured to look for investors who can bring relevant experience and knowledge to your business. Precisely, BDC has a venture capital team that supports leading companies that are strategically positioned in promising markets. Like most other venture capital companies, it participates in startups with high growth potential. Therefore, when a company needs a lot of financing to gain a foothold in its market, it's more willing to focus on major interventions. 4. Angel. Angels are usually wealthy people or retired corporate executives who directly invest in small companies owned by others. They're truly administrators in their particular areas. They not only contribute their own experience and network, but also their technical and/or management knowledge. Angel investors tend to fund the early stages of a business through investments of $25,000 to $100,000. Institutional venture capitalists prefer larger investments, about $1 million. In exchange for their financial risks, they reserve the right to supervise the company's management practices. Specifically, this usually involves board seats and transparency guarantees. Angels tend to keep a low profile. To meet them, you must contact a dedicated association or search a website about angels. The National Angel Capital Organization, or NACO, is an umbrella association meant to help Canadian angel investors build capabilities. You can check their member directory for contacts in your area. 5. Business Incubator. Business incubator, or accelerators, usually focus on high-tech fields and provide support for new companies at different stages of development. However, there are also local economic development incubators that focus on areas such as job creation, revitalization, and hosting and shared services. Ordinarily, incubators will encourage approaching companies and other fledgling firms to share their venues, as well as their organizational, logistical, and technical resources. For instance, incubators may share the rights to use their laboratories so that new companies can develop and test their products more cheaply before starting production. Generally speaking, the incubation stage can last up to 2 years. Once the product is ready, the company usually leaves the incubator and enters its industrial production stage and proceeds independently. Companies that receive such support usually conduct business in the most advanced fields such as biotechnology, information technology, multimedia, or industrial technology. Well, Mars, an innovation center in Toronto, has curated a list of business incubators in Canada and provides links to other resources on its website. 6. Government grants and subsidies. Government agencies provide funding such as grants and subsidies that your business may receive. The Canadian Business Network website presents a full list of various government affairs at the federal and provincial levels. Standard. Speaking of standards, obtaining funding can be difficult here, as there may be fierce competition and the standards for awards are often very strict. Generally, most grants require you to match the funds you receive, and this amount varies from one grantor to another. For instance, a research grant may only require you to find 40% of the total cost. Generally addressing what you all need to consider and provide is your detailed project description with explaining the benefits of your project. Next, a detailed work plan includes all costs relevant to experience and background details of key management personnel. Fill out the application form when appropriate. Most reviewers will evaluate your proposal based on the following criteria: significance, method, innovation, professional knowledge, assessment, need funding. Some of the problem areas where candidates fail to receive funding include research work irrelevant, unqualified location. Applicants fail to communicate the relevance of their ideas. The proposal doesn't provide a strong reason. The research plan has no focus. Unrealistic workload. Funds do not match. 7. Bank loan. To be precise, bank loans are the most usually utilized source of funding for SMEs. Acknowledge that all banks offer diverse advantages, whether it's personalized assistance or customized repayment. It's a good idea to shop around and find a bank that meets your specific needs. Generally speaking, you should know that bankers are looking for companies with good records and good credit. A good idea is not enough. It must be supported by a reliable business plan. Startup loans usually also require the entrepreneur's personal guarantee. BDC provides entrepreneurs with startup financing during the startup phase or the first 12 months of sales. You can also defer the principal payment for up to 12 months. This was all about it. Thank you for watching the video. If you enjoyed it, please like it and subscribe to the channel. Please let us know your thoughts in the comment section.